Alexandria Real Estate, a new REIT, a new entrant to the alternative perspective analysis. It's a REIT with 7.5% in the natural life sciences and health pharmaceutical basically company space. It's a niche company. It's probably the biggest player. It is a company that boasts a 12.16 billion market cap at the moment. Enterprise value of 25.15. So carries a good amount of debt. It's very typical for a REIT to have this much debt. The debt is really not a problem. The price to FFO ratios are looking really healthy. Even though it took a hit in the last quarter because of tenant leaving, Moderna specifically, and a third of their clients that are not Moderna also leaving. 2/3 of their people that are leaving are from San Francisco, but thankfully, as we can see over here from their website, they're geographically diversified. I don't know what the proportion is in each area, but I know Boston, greater Boston area is a big pharmaceutical, life sciences type of area. But either way, the client base is very steady. This figure here is pretty important. 12.2 years average debt term, which is very, very long, very stable. The FFO looks like it's going to grow by 10 cents in the next year and on the way to recover. Another interesting thing about this company, another positive, is that their rents increase quite frequently, unlike a REIT like Realty Income, for example, that has increases maybe like 1 or a little bit more than 1% per year. Alexandria increases rent by like 7.5% a year. So they're really aggressive on the rent increases. So even if somebody drops out, the rest of the tenants kind of pick that up and they make up for the fact that someone's dropped out. So even though the occupancy rate is down, the FFO might not take as big of a hit. So you can see the occupancy dynamics from last quarter. We went from 94.6 to 91.7%, but a third of that is set to basically they already have tenants filling in some of those buildings. So I'm expecting the tenant base to increase, the occupancy rate to increase, the FFO to increase, the money coming in to increase, and I think the dividend will be safe. The company severely underperformed all REITs and S&P 500 in the last 12 months, presenting us with a bit of an opportunity. 7.5% yield, if it's sustainable, which I believe it is actually kind of attractive. I mean, right now, Realty Income's paying maybe about 5.6% or something like that, and you can draw cash a little bit over 5% or around there from Robinhood Gold, for example. You can get some really, really low rates, and you can collect a positive spread. I mean, that's how monies are made, really, right? I'm not saying you should do this. That's actually kind of what I'm doing. But I'm not saying that that's a good idea for you. Perhaps just own it in a cash account if you want. But I think 7.5% doesn't look like it's going to take a hit. The only a hit it took really was in 2008. And then I believe in 2020 for a little bit. And it wasn't even that much of a hit. Let me see if I can find the dividend history here real quick. Oh, these figures are also important. So a shareholder yield is 7.21%, but they're actually buying back shares now. So even though it seems like they've sold shares to make the shareholder yield less than their dividend, they're actually buying back shares now. So this figure is going to explode if we get some tenants back online and they keep repurchasing shares. So there's going to be over the dividend rate, probably into 8, 9, 10%. In the coming quarter or two, because I think this is on TTM basis, on trailing 12-month basis. Here's the history for the dividends. It's a constant increase. Let's see from a graphical manner. So dividend chart Here it is from 2016. They haven't actually taken a hit at all. It seems like I thought they went down in 2020, but this chart does not show this. I thought they went down to like 88. It seems like a steady growth forward and only a slowdown recently, um, of course, due to the exit of their tenants, and they have to reshuffle the buildings a little bit. So it looks like it's a temporary, situation. Trailing 12 months. Well, this is for last 10 years. Let's see if we can make it 5 years. Looks like it didn't drop. How about in this history here? 2020, no drop. So the only time they really cut their dividends 2008, understandably. But other than that, they've held the dividend pretty strong. I mean, if they could go through 2020, well, I guess it kind of makes sense because, there was a lot of work for people during COVID and stuff in that line of work. And now, I guess some of the companies like Moderna are suffering because, they're not getting as much business. Maybe they have to like release some buildings. But it's a good way, in my opinion, to kind of like have a put on or sell a put on the industry through their housing, or kind of like maybe own bonds. It's very similar to owning bonds in companies in that industry. I think of it kind of like as buying bonds, an index of bonds in the life sciences companies, but maybe that pays a higher rate, so with the potential for growth, right? So increasing dividends rather than bonds where the yield is static. Also having a locked in debt for 12.2%. I'm sorry, for 12.2 years. That's high debt, 12.2. It adds a lot of predictability to the REIT, and so the management team can operate freely, knowing exactly what their cost basis needs to be. And with raising rents 7.5% a year, I mean, think about how well that's going to show up, even if the interest rates that they're paying are not as static as the management might hope. The increases in rent is more than enough to offset any kind of rejiggering, even if it's sudden, especially since their liquidity looks like it's pretty good. The only thing that could go wrong is losing more tenants. So maybe this REIT's been sold off so hard because somebody has insider knowledge that they're going to lose even more tenants. And if that happens, then yes, that's the downside risk that we're taking here. If more tenants are lost, then there's going to be a bigger hit on the money coming in, and then they're going to have to actually probably run through all their liquidity. They might not want to decrease the dividend right away, and so they're going to put themselves in debt because they want to keep that dividend paying out. And with the inability to refill those buildings with new tenants, that's going to be trouble, right? Then the rate will really drop, and it's going to be a slow, protracted, and very painful drop at that too, because every day that you don't fill those buildings up, the price at which you might get for new tenants lowers, and on top of that, you have incurring costs, right? It takes money to maintain those buildings and to have them listed, right? You're paying your management team, you're paying, issuing stock awards or whatever you're doing. It costs money to maintain buildings, so if there's no rental revenue coming in, it becomes very costly. So not only are you losing money as a company, but you're also lowering the rate that you're expected to accept moving forward because there's not enough demand for your buildings, right? The sector is in trouble. So that is the bear case scenario. It doesn't seem like that's going to materialize though. It seems, from an outside perspective, I'm not a specialist, I'm more of a generalist, but from an outside perspective, it doesn't seem like inflation and rent increase is going to be not a thing in the future. It seems like that trend's gonna continue. That's for sure. Um, all of the buildings are local. There's no international risk really. So nominally, the company should do all right. They don't suffer foreign exchange risks and things like that. Um, so I think it's actually probably worth the risk. I'm actually have already put some money to work in Alexandria. I've capped it off. I've sold a call against it at $72.50. So if that hits, then I'm out of the position with a small profit. But if it doesn't hit, I'll probably use I'll draw more on my personal revolver, my margin account, and I'll buy some more, and I'll probably keep selling calls in order to accumulate a large position of the company. And at some point, maybe down in the 60s, I won't sell calls anymore, and I'll just let it run. If I'm lucky enough to accumulate, if the company shows signs of trouble, I'll have to sell at a loss. I mean, that's one of the downsides here is that as an investor, I think it can be prudent to try to keep track of the downside of the developments, and so it's basically work. I mean, you can't just buy it and set it and forget it, right? You can't just buy it and leave it, kind of like you can with some other companies. You have to monitor this one, and if things are going not your way, you probably have to take a loss. I'll probably have to sell at a loss because I don't want to ride that downward spiral and hope every day that they get a tenant in some of their bigger buildings. So I think it's worth the risk. It's unlikely that there's going to be a lot more tenant losses. Could happen though. Again, you got to monitor it, collect that 7.5% yield, and good luck to everyone who owns this. Let me know if you do own it. Also, please let me know in the comments what I forgot in my analysis, or if you think you have interesting angle about anything about the company at all, and then let me know, because we need to help each other research so we can all get rich, right? Not just one of us. Don't be holding that information for yourself. If you have something interesting, share it here. Okay, we can all get rich. It doesn't have to be just you. Don't be selfish. Stop.